Crypto is not a hedge in this environment. It is viewed as the ultimate risk-on asset and is being sold accordingly. The fact that even stellar earnings from a tech giant like Nvidia are merely a buffer against further falls tells you how fragile the entire risk asset complex has become. The actionable insight: your analysis must now extend beyond chart patterns. You must ask, what is the leverage situation in the market? Are major holders, DAT, under pressure? What is the trajectory of global liquidity? These systemic and macro factors will dictate the duration and depth of this downturn far more than any technical support. 3. Your strategy must shift from speculation to conviction and horizon management. This confluence of broken psychology and systemic risk demands a fundamental reassessment of personal strategy. The old simple buy the dip mantra is being stress tested like never before, because the dip may be the start of a new bear market, not a pause in a bull run. This moment serves as the ultimate filter separating two distinct types of participants. On one side are the short-term speculators and leverage traders. For them, the environment has become brutally hostile. The volatility is not opportunity. It is ruin, amplified by the automated systems waiting to liquidate them. On the other side are the true long-term holders. For them, this is a test of core conviction. Do you believe in the fundamental thesis of decentralized digital assets beyond this cycle? If the answer is yes, then your strategy must be governed by horizon management. This means adopting a 3 to 7 year time frame, completely divorcing yourself from weekly or monthly price action. It involves methodically accumulating assets you believe in, understanding that prices may get far worse before they get better, and having the capital and psychological fortitude to weather that storm. The universal lesson, painfully highlighted now, is the catastrophic cost of never taking profits. Profits are not just gains. They are risk capital recycled into opportunity, and they are the psychological armor that lets you watch a downturn with clarity, not panic. The actionable conclusion: this is not a time for bold, all-in call. It is a time for diagnosis, preparation, and disciplined execution. Define which camp you are in: the short-term trader who must prioritize capital preservation and extreme caution, or the long-term holder who must fortify their conviction, extend their horizon, and plan a careful accumulation strategy. Your move in the next 30 days, guided by this understanding of broken sentiment, systemic risk, and macro decay, will define your financial outcome for the next 30 months. The roadmap to maximum opportunity is being drawn in a time of maximum fear, but only for those who can see clearly through the panic. For a content creator in the finance and crypto space, the current market crisis represents both a massive viewership opportunity and a significant creative challenge. Success hinges on structuring a narrative that is not only accurate and urgent, but is engineered for maximum retention and impact. This breakdown deconstructs the optimal script architecture for covering this sentiment apocalypse, transforming raw analysis into a compelling viewer journey. 1. The hook and problem framing. The 7-second rule of engagement, the opening moments, are non-negotiable. You cannot start with a data point or a gentle welcome. You must declare the new reality. A hook like, "The mood across crypto has officially shattered," serves this purpose perfectly. It is visceral, emotional, and frames the entire video as a diagnostic session for a critical condition. It promises the viewer an answer to the what and the why of their own anxiety. Immediately, this must be coupled with a high-stakes time constraint to create urgency, because what comes next for your portfolio will be decided in the next few weeks. This transforms the video from passive commentary into an essential, time-sensitive briefing. The viewer is no longer just curious. They feel they are about to receive intelligence critical to their financial survival. This hook must be delivered against stark, high-energy visuals, rapid cuts of crashing charts, red cascading numbers, or a concerned host in tight focus to match the auditory urgency with visual tension. The first 7 seconds must answer the viewer's subconscious question: why should I stop scrolling right now? 2. The deep dive and layered evidence. The narrative engine of retention. Once you have the viewer's attention, you must build a layered, undeniable case. Presenting facts in a logical, escalating sequence is key to maintaining retention through a longer form video, 15-20 minutes. This is not a data dump. It is a curated evidence trail. Layer 1. The objective data foundation. Begin with the indisputable numbers to establish credibility and scale the problem. Liquidation totals, $2.02 B plus, percentage drops, Bitcoin 10%, and the quantitative horror of the fear and greed index breaking to all-time lows. This segment answers how bad is it with authority. Visually, this is where animated charts, full-screen graphics, and heat maps are most effective. Layer 2, the social proof and emotional mirror. After establishing the what illustrate the human feel. This is achieved through a montage of social media panic clips. Hearing real or actor portrayed, traders scream it's over or my coins are dead. Does two things: it validates the viewer's own fears, creating empathy, and it dramatically showcases the extreme emotional state of the market. It's a proof of concept for the shattered sentiment hook. This segment is pure B-roll and sound design, a sensory break from data analysis. Layer 3. The Contrarian pivot and false dawn. Just as the panic feels overwhelming, introduce a counter-narrative. This is the buy the dip contrarian take, best delivered via a clip from a known, passionate figure. This serves a critical narrative function. It breaks the doom spiral, introduces complexity, and preempts the viewer's thought of, but I've heard some people say to buy. By addressing it proactively, you appear balanced. More importantly, it sets up the next, more powerful pivot. Layer 4. The pivot to systemic and macro doom. The real enemy reveal. This is the climactic turn. After presenting panic, Layer 2, and hope Layer 3, you dismantle the simple hope with a more profound. The script must pivot with a transition like, but is that historical playbook still reliable when the global economic backdrop is cracking? This leads into the exposition of automated risks, ADL, the precarious state of digital asset treasuries, DAT, and the decay of macro liquidity. This section answers why is this time different or worse. It elevates the discussion from price action to system stability, making the video feel more insightful than reactionary news coverage. Visuals here need to explain complexity. Flowcharts for ADL cascades, graphics showing DAT holdings and cost bases, and side-by-side comparisons of crypto to traditional market indices. This 4-layer structure, data, right arrow motion, right arrow counterpoint, right arrow deep systemic analysis, creates a roller coaster of tension and release that holds attention by constantly introducing new, more significant information, preventing the narrative from going stale. 3. The conclusion, CTA, and positional framing. The value takeaway, the final act, cannot simply recap the doom. It must synthesize the analysis into a clear, actionable framework for the viewer and solidify the channel's role as their guide. The synthesizing thesis. The script must deliver a memorable, quotable line that encapsulates the entire video's thesis. This isn't just a market dip. It's a stress test for every holder's conviction. This frames the moment intelligently. It's not telling people what to do. It's defining the nature of the challenge they face. It makes the viewer feel equipped with a new lens. The strategic fork in the road. The conclusion should explicitly outline the two paths, mirroring the actionable keynote, the peril for the short-term speculator versus the long-term horizon required for the convicted holder. This provides personalized value. Viewers can self-identify and take away relevant advice. The value-driven CTA call to action, the request to smash that like button, must be explicitly tied to the value provided. If this analysis helps you navigate the storm, show some support. This frames the engagement as a fair exchange, not a beggarly plea. Mentioning the channel name Signals of Today here reinforces brand identity. The secondary CTA, joining the free community, the Watchtower, offers a next step for the highly engaged viewer, fostering a deeper relationship. The closing thought and future hook end with a forward-looking, slightly philosophical statement that reinforces the channel's strategic mindset. In times of maximum fear, the roadmap to maximum opportunity is being drawn. This leaves the viewer with a sense of sober preparedness rather than hopelessness, and it implicitly promises that this channel will be the one to help them read. The final sign-off. We'll catch you on the next one. Promises continuity, turning a one-time viewer into a potential subscriber awaiting the next crucial up. For the editor, this structure provides a clear map, a high-energy intro, distinct visual segments for each narrative layer, data graphics, social media montage, interview clips, explanatory animations, and a calm, authoritative conclusion focused on the hook. The pacing should mirror the narrative tension, fast and chaotic during the panic sections, slower and more deliberate during the complex systemic explanations, returning to direct, earnest address in the final CTA. This script architecture isn't just reporting news, it's crafting an experience that educates, validates, and guides the viewer, cementing the channel's authority in the process. The current cryptocurrency collapse represents a fundamental phase transition for the market. It is not merely a cyclical dip within an ongoing bull market, nor is it a simple correction driven by profit-taking. To interpret it as such is to dangerously misdiagnose the moment. The core thesis is that we are witnessing the convergence of three distinct catastrophic forces, a complete breakdown in market psychology, the acute exposure of latent systemic risks within the digital asset ecosystem, and a synchronous deterioration of the global macroeconomic foundation upon which all risk assets are built. This tripartite collision has shifted the environment from one of speculative opportunity to one of existential stress testing, forcing every participant, from the retail holder to the institutional treasury, to undergo a fundamental reassessment of strategy. The only viable paths forward now demand a shift from short-term, leverage-fueled speculation to a posture defined by either capital preservation or survival-focused long-term conviction. Evidence A. The breakdown of collective psychology, the sentiment apocalypse. The first and most visible force is the shattering of market sentiment. For years, the crypto market has operated on a bedrock of narrative, belief in technological inevitability, institutional adoption, and monetary revolution. Price corrections were weathered with the mantra, have conviction and zoom out. That foundational belief is now cracked. This is quantified by the Crypto Fear and Greed Index plunging into literal uncharted territory, breaking below all historical lows. This metric is not a casual survey. It is an aggregation of volatility, market momentum, social media sentiment, and dominance. Its collapse signals that the very indicators used to gauge crowd emotion have broken their gauges. We are in a sentiment vacuum. This psychological rupture manifests in two destructive behavioral cascades. First, there is the mechanical purge of 2 billion in leveraged positions liquidated, erasing hundreds of thousands of accounts. This is not organic selling based on reassessment. It is the automated forced ejection of participants, a process that feeds on itself as liquidations beget lower prices, which beget more liquidations. Second, and more culturally significant, is the narrative shift in community discourse. The conversation has pivoted from when is the bottom to declarations of finality. Crypto is finished, ATF are a failure. This was all. This is the language of capitulation, where greed has been entirely replaced by regret and self-recrimination. The dominant emotion is no longer, I wish I bought more, but why didn't I sell? This represents a profound psychological reset that cannot be reversed by a single green daily candle. A market can recover from a price crash far more quickly than it can from a shattered consensus reality. Evidence B, the exposure of latent systemic risk, the engine of contagion. Beneath the psychological storm lies a more insidious and dangerous force. The exposure of critical interconnected frailties within the crypto financial system itself. The ecosystem has grown in complexity, birthing mechanisms that function wonderfully in upward momentum, but become doom loops in decline. The paramount example is automated debt liquidation and related deleveraging protocols. These are not features, they are latent liabilities. When asset prices fall, these are not thoughtful margin calls from a broker. They are pre-programmed, non-negotiable sell orders that execute instantly. A drop triggers liquidation A, which pushes the price down to trigger liquidation B, creating a cascading failure that can crater an asset independent of any fundamental news. The recent catalyst, a purported software bug on a major exchange, is irrelevant. The bug was merely the match. The systemic leverage and automated liquidation protocols were the pre-stacked tinder. Simultaneously, we are observing the first major stress test of a new class of institutional participant, the digital asset Treasury, DAT. These entities, public companies, and funds that hold crypto as a primary reserve asset were hailed as pillars of the new institutional dawn. In a downturn, they are transforming from pillars into anchors. Many are now sitting on billions in unrealized losses, their primary mandates shifting from strategic accumulation to corporate survival. To defend their plummeting stock prices and satisfy balance sheet requirements, they may be forced to become persistent, structural sellers of the very assets they champion. This creates a slow, draining sell pressure that smothers rallies. Should one major DAT face a liquidity crisis or activist investor revolt, it could trigger a fire sale of monumental proportions. A black swan event born not from external attack, but from internal system design. Evidence C. The deterioration of the macroeconomic foundation, the tide going out. The third force is the most powerful and inescapable. The global macroeconomic tide is receding. The post-2020 era of ultra-cheap money, quantitative easing, and fiscal stimulus, the rocket fuel for all risk assets, including crypto, is unequivocally over. We are now in a regime of quantitative tightening, high real interest rates, geopolitical fragmentation, and looming recessionary fears. Cryptocurrency has decisively failed to act as an inflation hedge or uncorrelated asset in this environment. Instead, it has behaved as the ultimate risk-on speculative asset, its beta to traditional tech stocks higher than ever. The market is now punishing assets not for their individual merits, but for their place on the risk spectrum. This is evidenced by the fact that even staggeringly positive micro-events, such as Nvidia's historic earnings, are now merely serving to buffer against further systemic falls, not spark new bull runs. The entire financial system is liquidity-starved. When the Federal Reserve drains liquidity from the system, the most speculative, volatile, and leverage-sensitive assets are the first and hardest hit. The current crypto crash is therefore not an isolated event, but a leading indicator and a direct symptom of a broader contraction in global financial liquidity. The market is not trading crypto narratives. It is trading dollar scarcity and risk aversion. Conclusion: the imperative for strategic reassessment, the convergence of these three forces, broken psychology, exposed systemic risk, and decaying macro liquidity, creates a combinatorial effect far more severe than the sum of its parts. It signals a high probability that we have crossed a threshold from a bull market correction into the early stages of a new bear market. In this environment, the old playbooks are obsolete. The buy the dip mentality assumes a functioning, sentiment-driven market. It fails when facing automated deleveraging spirals and institutional force selling. The just hodl mantra assumes infinite time horizon and psychological fortitude. It is shattered by the reality of systemic contagion that can permanently cripple projects and protocols. Therefore, this moment forces a binary, fundamental reassessment. For the short-term trader and leveraged speculator, the only prudent strategy is one of extreme capital preservation, radical de-risking, and acceptance that the game has changed to one of survival, not conquest. For the long-term believer, strategy must harden into one of rigorous conviction and horizon management. This means adopting a minimum 3-7-year outlook, methodically accumulating based on unwavering fundamental belief, not price action, and securing assets in self-custody to weather potential exchange or counterparty failures. It requires acknowledging that prices may fall much further and having the financial and emotional capital to endure that. The market is no longer filtering for optimism. It is stress testing for ultimate, unshakable conviction. The roadmap to the next cycle's maximum opportunity is being drawn today in the ink of maximum fear, and it is a map only the most prepared and clear-sighted will be able to follow.